Worries about the stability of the banking system have spread from the US to Europe.
Are you considering investing in German stocks? Think twice before making a move. While Germany may be known for its strong economy and reliable financial system, there are several factors that could make investing in German stocks a risky move. Hello everyone, welcome back to our YouTube channel. In this video, we will explore the reasons why investing in German stocks may not be a wise decision. Investing in stocks is a popular way of generating wealth and building a diversified investment portfolio. However, it is important to exercise caution and make informed decisions when investing in stocks. One country that has recently been the subject of cautionary warnings when it comes to investing in its stock market is Germany. In recent years, Germany has faced a number of economic and political challenges that have affected its stock market performance. This video provides an overview of the German stock market and explores the reasons why investing in German stocks may not be a wise decision. So without further delay, let's get straight into the video. First, let's talk about reasons for warning against investing in German stocks. Weak performance of German companies. The weak performance of German companies is one of the key reasons for the warning against investing in German stocks. Many German companies have struggled to compete on a global level, with some failing to adapt to changing market conditions and technological advancements. This has led to a decline in earnings and profitability, which in turn has impacted the performance of German stocks. Some of the challenges facing German companies include increasing competition from emerging markets, rising labor costs, and the need to invest in new technologies and innovation. Additionally, some German companies have faced reputational damage due to scandals and controversies, which has further impacted their performance. Overall, the weak performance of German companies has made investing in German stocks a risky proposition for many investors. Low growth prospects. Germany has long been considered a powerhouse in the global economy. The country's strong manufacturing sector, robust financial system, and highly skilled workforce have contributed to its reputation as a reliable and stable economy. However, in recent years, Germany's economic growth rate has slowed down, and the COVID-19 pandemic has only made matters worse. In 2020, Germany's economy shrank by 5.3%, marking the worst annual contraction since World War II. While the country's economy is expected to rebound in 2021, it is unlikely to return to pre-pandemic levels anytime soon. One significant factor that could limit Germany's growth prospects is its aging population and low birth rates. As the population ages, there will be fewer people in the workforce, which could lead to labor shortages and limit economic growth. Additionally, Germany's traditional industries, such as manufacturing, are facing increased competition from other countries, particularly in Asia. How impressed are you by the above information? Let us know in the comment section. High taxation. Germany's high taxation rates are a significant challenge for businesses operating in the country. The high taxes can significantly impact a company's bottom line, making it difficult to invest in research and development, hire new employees, or expand operations. Additionally, the German government often changes tax policies, which can create instability and uncertainty for investors. One area where high taxes can have a significant impact is in the labor market. Germany's high income taxes can make it difficult for companies to attract and retain highly skilled workers, as these workers may be able to earn more in other countries with lower tax rates. Additionally, the country's social security contributions, which are used to fund social welfare programs, are also high, which can add an additional burden to businesses. Overall, while Germany's high taxation rates are intended to fund social welfare programs and support the country's economy, they can also limit the potential for growth and innovation. Companies looking to invest in Germany should carefully consider these tax policies and their potential impact on their bottom line before making any investment decisions. Declining industrial sector. Germany's industrial sector has long been considered a key driver of the country's economy, with many of its most successful companies operating in the manufacturing and engineering sectors. However, in recent years, the country's industrial sector has been in decline, with a decrease in demand for German industrial products. One significant factor contributing to this decline is the rise of automation. As more companies adopt automated production processes, there is less demand for skilled manual labor, which has traditionally been a strength of the German manufacturing sector. This can make it difficult for companies in other sectors to thrive, as they are impacted by the decline in the industrial sector. Stay connected. Maybe we are just jumping into an end. Increasing regulations. Germany is known for having strict regulations on businesses, particularly in the finance and banking sectors. While these regulations are intended to protect consumers and investors, they can also create barriers for companies looking to enter the market. These regulations can create additional costs for businesses and limit their ability to innovate and adapt to changing market conditions. For example, companies in the finance and banking sectors may face strict requirements related to capitalization, risk management, and disclosure, which can make it difficult for new and innovative companies to enter the market. Additionally, there may be requirements related to compliance and reporting, which can create additional administrative burdens for companies. While these regulations are intended to protect consumers and investors, they can also limit the potential for growth and innovation in the economy. Now let's talk about geopolitical risks. As a member of the European Union, Germany is impacted by the geopolitical risks facing by the euro. These risks can include economic uncertainties, political tensions, and security threats. For example, Brexit has created uncertainty for the EU's economy and trade relationships, which can impact German companies that do business with the UK. Ongoing tensions with Russia can also impact Germany's energy security, as the country relies heavily on Russian natural gas. The refugee crisis has also been a significant challenge for the EU, with many countries, including Germany, facing an influx of refugees and migrants. This has created political tensions within the EU as countries struggle to agree on a common response to the crisis. Additionally, there are concerns that the crisis could impact the EU's economy, particularly if it leads to increased social and political instability. While Germany may seem like an attractive place to invest, the risks associated with investing in the country's stock market are significant. Low growth prospects, high taxation, a declining industrial sector, increasing regulations, and geopolitical risks are just a few reasons why you should avoid investing in German stocks. Before making any investment decisions, it's essential to carefully consider all factors and do your research to ensure you're making a wise investment. This was all about today's video. See you soon in the next video. If you enjoyed this video, we would love to hear how much you enjoyed it. Feel free to leave a comment. Be sure to subscribe to the channel so that you can see more awesome videos like this in future. Thank you.